Here is something that is happening right now, and most retirees don't even realize it. Right now, someone is opening their brokerage app. The S&P 500 is down. The news is loud, and they are about to make a decision that could cost them years of retirement income. Meanwhile, someone who made one quiet, patient choice about where to invest is watching their SCHD position. Their dividend arrived last week, the week before that, and the week before that, and they are not panicking. By the end of this video, you will understand exactly why SCHD is up over 12% this year, while the S&P 500 is down, what that gap means for your retirement income, and what the smartest retirees are quietly doing with this information right now. And the part most people miss? This gap was not a surprise. It was predicted by 51 years of hard data. We're going to walk through that together today. Quick note before we go further. I'm not a financial advisor or a government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's start with the numbers. On January 28, 2026, the S&P 500 hit 7,002 for the first time in history, an all-time high. The financial media was celebrating, and then the world changed. By early April, the S&P 500 had fallen to roughly 6,583. That's approximately a 6% drop from the January peak. At the worst point in mid-March, the index had dropped nearly 9% from its high. Now, here's the number that changes everything. During that same period, SCHD, the Schwab U.S. Dividend Equity ETF, is up over 12% year-to-date. The S&P 500 is down roughly 5%. SCHD is up over 12%. That's a gap of approximately 17 percentage points, one of the widest outperformance margins in SCHD's entire 14-year history. But before we celebrate, we need to understand exactly why this is happening, because most people have the reason completely wrong, and the real reason tells you whether this outperformance is built to last or whether it fades. What's actually driving this correction? You've probably heard several explanations for why the market is down. Tariffs, AI valuations, Washington. Those things matter at the margins, but they're not the primary driver. The real catalyst is something bigger, and it started on February 28, 2026. That's the day that military strikes were launched on Iranian nuclear and command facilities. By March 4th, Iran responded by closing the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's daily oil supply flows. Oil prices exploded. Brent crude went from approximately $71 per barrel before the conflict to peaks over $112. That's the largest monthly oil price surge in recorded history, and it happened within days. When oil spikes that fast, everything connected to energy costs goes up with it. Consumer confidence fell to 56 on the University of Michigan Index, firmly in the range that has historically preceded recessions. Moody's Analytics puts recession odds at nearly 49% right now. Goldman Sachs is at 30%. JP Morgan is warning this is not just a short-term inflation bump, this is a genuine economic shock. And that brings me to the myth I want to address head-on. Here's the myth. Market corrections hurt every investor equally. Here's the truth. They never do. And dividend-quality stocks have consistently outperformed in exactly these kinds of environments for 51 years in a row. Here's why SCHD is structurally built for this specific moment. SCHD holds roughly 19% in consumer staples, companies like Coca-Cola and PepsiCo that people keep buying regardless of economic conditions. About 17% in healthcare. People don't postpone medical care in a recession. And after the 2026 reconstitution, about 16% in energy, which has been a direct beneficiary of the oil surge. Meanwhile, SCHD holds only about 9% in technology. The S&P 500 holds about 30%. Software stocks dropped approximately 25% from their 200-day averages during this correction. SCHD barely felt that pain. Now you know what's driving the correction, but here's what almost no one is talking about. This pattern was not invented in 2026. It's been documented across every major market downturn for the past 5 decades, and the numbers are remarkable.
The 51-year proof. Hartford Funds and Ned Davis Research studied the performance of dividend-paying stocks across every major bear market since 1972. That is 14 bear markets spanning more than half a century. Across all 14, dividend-paying stocks outperformed non-payers by an average of 12.5 percentage points per downturn. Not in most of them, in every single one. Now let us look at SCHD's specific record, because history is the best argument. In the 2018 Q4 sell-off, the S&P 500 dropped nearly 20% from peak to trough. SCHD finished the full year down just 5.56%, a dramatically smaller decline. In the 2020 COVID crash, the S&P 500 fell 34% at its worst point. SCHD fell roughly 30%, painful, but measurably less so. For the full calendar year, SCHD returned positive 15%, and its dividend grew over 17%, not cut, grown, through a global pandemic. In the 2022 bear market, the last major test before this one, the S&P 500 fell 18%. SCHD fell just over 3%. That's a 15-point cushion. And SCHD's dividend grew 13.9% that year. And right now, in 2026, SCHD is up over 12%, while the S&P 500 is down. We are watching this play out in real time. This is not luck, it is structure, and the structure comes from disciplined sector positioning, quality dividend screening, and an income stream that doesn't care what the price is doing on any given day. Now here's where the 2026 story gets even more interesting. Look at how SCHD compares to the other major dividend ETFs, including the covered call funds many retirees have been chasing for their high headline yield. SCHD is up over 12%. HDV is close behind at nearly 12%. VYM is up about 4%. And then look at JEPQ, up just 1.77%. JEPI up just 0.5%. The covered call ETFs that so many retirees have been drawn to for their high yields are sitting essentially flat, while SCHD surges. The S&P 500 is down 4.6%. SCHD is up 12.35%. That single comparison tells the entire story of 2026. But here's what surprises even long-time SCHD holders. It's not just that the price held up. The dividend kept growing even through every crisis, and understanding why changes you how you think about corrections permanently. The dividend never stopped. I want you to meet Robert and Patricia. They're 68 years old. They retired to Colorado 3 years ago. They have $500,000 invested in SCHD. Their neighbor has been sending them news articles all week about the S&P 500 falling and suggesting they move everything to cash before things get worse. Robert and Patricia are not moving to cash. Here's why. At SCHD's current yield of approximately 3.5%, their $500,000 position generates about $17,500 per year in dividends. That's roughly $1,458 every single month deposited directly into their brokerage account, without them selling a single share, without them making a single trade. That income doesn't care what the S&P 500 is doing. It doesn't check the VIX. It doesn't watch oil prices. It just arrives because the companies inside SCHD keep generating earnings and keep paying their dividends. Now here's the proof that this is not theory. In 2020, when the S&P 500 crashed 34% and many investors were genuinely terrified, SCHD's quarterly dividends never stopped. For the full year, the dividend grew 17.6% over the prior year, not cut, grown, through a global pandemic. In 2022, when the S&P 500 fell 18% across the full calendar year, SCHD's dividend grew 13.9%, not cut, grown, through the steepest rate hike cycle in 40 years. In Q1 of 2026, SCHD's dividend came in 3.3% higher than the same quarter last year. The income keeps growing while the headlines keep screaming. And here's the data point I want every nervous investor to sit with for a moment. JP Morgan studied 20 years of S&P 500 returns from 2005 through 2024. $10,000, fully invested the entire time, grew to roughly $71,750. But if you had missed just the 10 best trading days out of 5,000, 10 days you can't predict, your result dropped to $32,871. That's a 54% reduction from missing just 10 days. Here's the detail that truly changes things. 7 of the 10 best market days happened within 2 weeks of the 10 worst days. The explosive recoveries come immediately after the peak panic, and the investors who missed it missed all of it. Before we move to the next section, I want to hear from you. Is SCHD already part of your retirement portfolio, or are you still on the fence about dividend investing? Drop your answer in the comments right now. I read every single comment, and I genuinely want to know where you are.
So now you know the income is holding. But here's what most people are completely missing. This correction actually creates 3 specific opportunities for prepared retirees. None of them require selling anything. The first opportunity is the Roth conversion window. When your portfolio drops in value, you can convert more shares from a traditional IRA to a Roth IRA for the same tax cost. If your portfolio dropped from $500,000 to $425,000, converting the same dollar amount now moves a larger percentage of the account into permanent tax-free status. When the recovery comes, and history shows it always does, that recovery happens entirely inside the Roth, untaxed forever. A married couple with no other income can convert up to approximately $133,000 and stay within the 12% bracket. The correction makes that window larger and cheaper at the same time. The second opportunity is one most retirees never see coming. It is the IRMAA trap for panic sellers. If you sell investments and realize large capital gains to move to cash or to something that feels safer, that income spike can push your Medicare adjusted growth income above a threshold. Medicare looks back 2 years when calculating your premiums. Cross the wrong line and you trigger surcharges on your Medicare Part B and Part D costs. A married couple with $180,000 in baseline income that sells and realizes $60,000 in gains is suddenly at $240,000 and owes roughly $2,300 more in Medicare costs every year going forward. A larger sale can trigger over $9,000 in extra annual costs. Staying invested in SCHD protects you from that trap entirely. SCHD generates steady, predictable dividend income, not sudden large spikes that push you over a cliff. The third opportunity is the qualified dividend advantage, and this is where SCHD pulls clearly away from the high-yield alternatives. SCHD pays approximately 100% qualified dividends. For most married retirees with taxable income under roughly $99,000, those dividends are taxed at 0% federal, not 22%, not 37%, 0. Now, look back at that ETF table. JEPQ pays an 11% yield, but it's ordinary income, taxed at your full marginal rate. For a retiree in the 22% bracket, the tax difference on $50,000 in dividends is over $11,000 per year. and JEPQ delivered just 1.77% in total return this year, while SCHD returned over 12%. The headline yield wasn't the real story. SCHD gives you income you can actually keep after taxes, and total return the alternatives cannot match. The market doesn't pay you to panic. SCHD pays you to be patient. If someone you care about is watching their portfolio right now and feeling the urge to sell, forward them this video. It might be the most useful 15 minutes they spend on their retirement this year. Tell me in the comments, when the market drops, does receiving your dividend income make it easier to stay the course, or do you still feel the pull to move to cash? I genuinely want to know where you are with this. If you want to stay ahead of changes like this, the tax angles, the dividend strategy, and everything that protects your retirement income, subscribe to Dividend Hustle. That's exactly what this channel is built for. And next time, we're going to look at something I've been getting a lot of questions about: JEPQ's tax situation in retirement. The yield looks incredible on the surface, but there's a cost most retirees are not calculating. That video is coming up next.